We at River1 think some value names are really attractive down here. We got an ask from YouTube, from Jordan, to do Charter Communications. Take a look at this chart. It's up 30% in the last couple of weeks on this deep value play. We're gonna go through Charter Communications and what's going on and whether or not we see value down here. This is the description page on Bloomberg of Charter Communications, and there's some attractive numbers on here, specifically this one right here. Look at this PE, sub-4x PE. Compare that to about 22 for the market. Oh man, is that cheap. This PEG ratio down here, well below 1. But let's take a look at what's actually going on with Charter Communications and why we think the stock has had a little up move right here. Here's what we really think is going on at Charter. We think it's a short squeeze. We think they're at 20 million shares short here and a 78 out of 100 short squeeze ratio. We think those are the people that are buying the stock right now, not new entrants, and we'll show you why this stock isn't as cheap as it appears on that DES page. So that 4 PE, it looks attractive, right? It's lying to us. It's not telling the truth. Take a look at the real FA page here, and you've got $94 billion in debt, right? So the company's doing well from a revenue perspective. $55 billion in revenue, it turns it into $22 billion in EBITDA. That's good, right? But it can't pay you, the shareholder. It has to pay the debt holder. In fact, it pays about $10 billion in interest to the debt holder. Then it takes another $10 billion, or 11 in this case, and spends it on CapEx. New trucks, new wires, all the things that it takes to run the cable company. So at the end of the day, the free cash flow yield here, which is only about $5 billion against the enterprise value, is about a 3 to 4% free cash flow yield. If I'm looking for a real great value investment, I'm looking for 10, 11, 12% free cash flow yield. Why? Because they can then buy their own stock back with the extra money that they have and drive that PE from 4 to 10 because it's justified. These folks don't have enough money to buy their stock back. They are paying mostly their debt holders and mostly their CapEx bill, and then there's a little left for shareholders. So I don't want to be an equity holder of Charter. What I wouldn't mind being is a debt holder. I think that they're going to be able to pay this 10, 12% yield that they have on their debt probably for the next 4 to 5 years. And so if I'm a debt buyer, this is probably a company I think is fairly safe, that they're going to be able to manage this and pay their debt. So when the yield gets juicy, I would definitely look at this one as a good place to buy debt, but not equity. So thanks again to Jordan for the request here on Charter Communications. We appreciate everything you guys do for us. If you guys want to see something, let us know. Also, you can subscribe to our morning note. The link is in the comments.